One of the problems of being the last speaker in the day on a subject that seems to be exercising almost the whole of the world, i.e. what is happening in the European Union, is that everybody's touched on what you're going to say in some form or other. And also, the other difficulty of being the last speaker is the size of the audience gets smaller and smaller. So for those of you who have stayed behind, thank you. It was mentioned that I had 30 years experience. I had 30 years experience as a partner in an international firm. I am actually in my 50th year in the profession. And I must say that over the last couple of years, I've never experienced change like the way I'm experiencing now and probably will in the next few years. My talk is about professional accounting challenges in the EU, and there are many, many challenges. Europe has many challenges. It's got political challenges, it's got Eurozone challenges, and it's got austerity challenges. Jim mentioned about the sovereign debt, and that is a major, major issue in Europe that is exercising. So to think that accounting and auditing challenges in Europe are at the top of the political agenda would most certainly be wrong. And that's a major problem for the profession, as our profession in Europe is in focus politically. Politicians like to horse trade in order to get what they want, and therefore matters relating to our audit profession could be horse traded, and that is a major concern. And we need to work hard to stop this happening, and this is what we're doing. And so I would share with you some of the thoughts that we at Fee have and some of the matters that are exercising us at this point in time. But what's happening in Europe, as you've already heard over the last few days, isn't just isolated to Europe. It's affecting all jurisdictions and certainly is affecting the US. And I had a meeting with Jim Doty only a couple of weeks ago, and you can see the same things coming up. They're being influenced. The PCAOB are being influenced by what's happening in Europe, and a lot of the concept releases that you saw on the slide earlier have come as a direct response to questions being raised in in Europe. So let's just give you a little insight into what Fee is to start off with, because that does put into perspective. As was said, we do represent 700,000 professionals, and they are professionals who not only are in practice, but are in the public sector, are in industry and commerce. We have 45 professional institutes in Europe that we represent, included and represented in 33 countries, which also include all 27 member states. We engage with our stakeholders, and they are many. The European Commission, the European Parliament, the Council of Ministers and their committees. We have international connections and give input into all manners of things with IFAC, PCAOB, SEC, etc., etc. And you can see on that slide, it is all surrounding the activities that we do, particularly in Europe. So which areas do we actually spend most of our time? Well, you can see on that slide that we cover nearly everything that a professional accountant does. And I say professional accountant in its widest sense. As I said, it's not just those who are in public practice. Corporate reporting and sustainability is, I think, going to be the agenda item going forward once the audit policy debate has subsided and change is undoubtedly coming. I see that corporate reporting and sustainability to be something that will be really gathering momentum over the next few years. We heard from Jim with regard to public sector and public sector accounting. And certainly in Europe, that's again gathering pace. And so we're very active in that area. Clearly, ethics are important. We get heavily involved in company law and corporate governance, giving input with regard to audit committees and the way that the corporate governance regimes across Europe are changing. And I say regimes, there are many different regimes. There's different structures with regard to boards. In Germany, you have a two-tier board. In other countries, you have a one-tier board with committees. And so we're giving input into all those things. And we mustn't forget that the vast majority of the practitioners are SMPs. And so we have to keep an eye on the specific issues for SMPs, and you'll hear more about that from Federico tomorrow. And so a full and active participation in everything that we do. But I'm going to focus this afternoon on accounting and auditing. But before I do that, I think to put it all into context, I need to just talk about the legislative process within Europe and how it works, because it is not simple. And you've heard in other talks today the complexity that is around the legislative process in Europe. So these are the three main institutions. You've got the European Commission, so that is the executive body of the European Union. It proposes legislation, but it can't enact legislation. It doesn't have the right to do that. It can only propose legislation, and all the things that you're hearing are coming from the European Commission. It manages and implements EU policies, and it enforces EU law across the member states through the courts. And it represents the European Union in everything that it does. So that's the group that actually proposes the legislation. On the other side of the slide are two bodies. One is the Council of Ministers, the Council of the European Union. These are the member states. These are all 27 countries who obviously have an interest in the legislation that is taking place around the world, around Europe. And so it does legislate and it coordinates all the economic policies between the 27 member states. So it is a very, very critical part of the legislative process in Europe. And then we have the European Parliament, the elected members of the 27 member states. And they represent all EU citizens through that election process. And again, there its main attributes are legislation, the enactment of the law, but it also supervises the European institutions. And so it is quite a complex method of dealing with legislation. And so the Commission proposes legislation, it goes through the Council of Ministers, it goes through the European Parliament, and then those two groups co-decide, and then you get the final legislation. But there's an added complication, because over on on this side here, is that the Council of Ministers has a presidency that only lasts for 6 months. And it rotates around the various countries, all 27 member states. So they are the ones that drive the agenda that's particularly important to them. So that's important to know as well. And if you look at this group here, quite small countries have limited resources. And we've got the situation that Denmark was in the first half of 2012. They didn't get everything on their agenda through Parliament, and therefore there was a lag over to Cyprus, and now Cyprus are trying to deal with accounting regulation and audit regulation, and they don't have the people to do it. And so that's one of the major issues that's causing a slowdown. Ireland will take over on the 1st of January. And then after that, it's Lithuania and then Greece. And we know that, first of all, Lithuania is rather a small nation, and we also know that Greece has more problems than accounting and auditing to worry about. And so this is quite a significant part of the agenda and why people are looking to see whether things will speed up or slow down. On the other side of the slide over here are particularly important people. And so for accounting, Mr. Lehner is German, and he is the chair of one of the committees and is the rapporteur for the European Parliament. So he's the one who's speaking on behalf of the European Parliament in this debate. And in the auditing, you've got Sajid Karim and Kay Swinburne. And both of those people are from the UK. But one of the issues that the UK government has is that the Conservative government in the UK is actually a member of a minority group within Europe. And when I had a meeting at the European Commission only a few weeks ago, they were saying, yes, well, the proposals coming from the Parliament now are being delivered by somebody from a minority group. There's a long way to go to persuade the majority within Parliament that that's the right course of action. So you've got all these things intertwining within the legislative process, which doesn't make it very easy. And the way that the Parliament works is that they have the proposals, they discuss within Parliament, they then prepare papers, they produce a rapporteur's report with amendments, and I'll come to some of those later, and then it moves on to a vote in plenary, and then it ultimately it has proposals for legislation, and all the time sitting underneath, or they would hope sitting above, are the Council of Ministers, who are actually also feeding into this process. And that's why they have to, both those groups have to agree on the proposals before the legislation can be enacted. So it is a complex process. So let's just look, therefore, at some of the accounting directives and what's happening there. They are changing the 4th and 7th directives, and the 4th and 7th directives are basically, they set the framework for financial reporting and what should be reported, and it does depend on size. In Europe, we do have the situation where really there's no distinction with regard to the 4th and 7th directives, or primary distinction, between listed and unlisted companies, private companies. And so they're all expected to produce financial information, that it is designated through the 4th and 7th directives of what they have to report. But also, surprisingly, the accounting directives actually also determine which companies should be audited. And in Europe, unlike the US, there is a requirement for an audit for unlisted companies. And in some countries, it's every limited company. So it comes with the territory of limited liability in some countries that you have to have an audit. In others, the thresholds, which I'll just touch on later, determine whether a company has to be audited or not, and that's in regard to whether a company is a small, a medium-sized, or a large company. So it is an important factor for the profession, and it's an important factor for the reporting mechanism within Europe as to what these thresholds are and how they're applied in each of the 27 member states. I'll touch on the debate that's happening in Parliament and Council and see how that's going, and also what our own fee positions are. So what they've done with the 4th and 7th directive is that they've actually started from the think small first principle. let's not start worrying about the large companies. Let's start with the small companies and have a building block approach and move up the scale for more and more requirements as you get bigger and bigger and bigger. There's a new size category called micro entities, and there is a member state option to exempt those companies from actually producing financial statements and filing financial statements. But that's quite an interesting principle, and I'm quite sure that there are parts of governments, of member states, who won't be particularly happy with that proposal when you're thinking about tax legislation and collecting taxes. But it has gone through, and but it is a member state option whether they want to exempt those. So it's not coming from the European Commission as a regulation or as a directive. So it is a bottom-up reporting regime. And there are limited disclosure requirements for small companies, but they're ever changing as well. They are actually looking to harmonize the criteria for each of these categories of companies, micro, small, medium, and large, across all 27 member states. And you've got to remember that all these member states are a totally different scale. I mentioned Lithuania. If you look at Lithuania, it's a minute country within Europe. You look at Slovenia. Slovenia, for example, has 132 practicing auditors. That shows you the scale of their economy. And then you've got the might of Germany. But this is a one-size-fits-all process for harmonizing the criteria for each of those member states. So it is quite an issue when you get it down into the various jurisdictions. In Europe, it is mandatory at European Union level for medium and large-sized companies to be audited, and for public interest entities. And it's not just listed entities, it's public interest entities. So you can actually have some quite small companies that are deemed to be public interest entities. Any company, for example, that takes a deposit from the public, credit unions and things like that, could be quite small, but they are deemed to be public interest entities and in a specific regime. There is no EU-level audit requirement for small companies. That's a member state option that is currently in place. But what they're now changing is that you're going to have the member states will have to have an opt-in rather than an opt-out. An opt-out rather than an opt-in, and so it is quite a change in some jurisdictions. Let me just, these are the size of companies. These are in millions of euros. And so a small company, for example, has a balance sheet value of 5 million euros. This is the proposed, they're moving the thresholds. But that's really only inflation over the last few years. Net turnover of 10 million euros. And average of 50 employees. So that captures quite a large proportion of companies in Europe. Then there's the medium size, 40 million turnover, 250 employees, and then larger than those are deemed to, or any companies higher than that, are deemed to be large companies. So these are quite, this small company is particularly important when we look at the proposals. Every company in Europe that is a public interest entity or a listed entity, does require to have their financial statements produced under IFRS. They were looking to have full adoption of IFRS for SMEs, but that hasn't been pursued at European level. And there are actually a few obstacles. And the way this legislation is drafted, it will mean that because of these minor obstacles, companies under the original proposals could not adopt IFRS for SMEs, even if they wanted to. But I think there is going to be more and more debate on that. The big thing that is taking most of the time on the directive, on these two directives, is country-by-country reporting on payments made to governments by the extractive industries and forestry companies. Similar to US Dodd-Frank Act, this is really trying to see what is happening in these developing countries. But there is so much debate and so much difference of opinion across all the member states that this is causing a great slowdown in this process, and it's holding everything up. And I mentioned earlier about horse trading. This is the area where the horse trading is taking place on the accounting directives and what other things are happening. And one of the things that was going to be brought, there was an amendment put in by one of the MEPs to take out of audit medium-sized entities. But that, and it was felt that that was part of the horse trade that was trying to get this country-by-country reporting settled, but it's now been taken out of the proposals. They're also now Parliament and the Council are changing the drafts, putting in other proposals, and they see it on these slides. I'm sorry that you haven't got the slides in your pack, and that's because all this thing is happening absolutely in real time. They are actually meeting on a weekly basis in Brussels at the European Parliament, and all these matters are constantly changing. But one of the things that is of major concern to me and major concern to a lot of the profession is the limited disclosure that the European Parliament is talking about with regard to removing the requirement to disclose off-balance sheet transactions, post-balance sheet events, and related party transactions in relation to small companies. Well, let's just think about that. You know, if you want to hide anything, what do you want? You want off-balance sheet transactions, you want related party transactions, and you don't really want any post-balance sheet events showing. So this is a typical example where the European Commission really are trying to reduce administrative burden on the smaller companies, but focusing on things that are so important for the economy that it's just scandalous. But that's where they are. Now, the Council of Ministers at least have seen that as a failure. And one of their proposals is that there should be an option at member state level. So they're not saying that at a European Union level, this is mandatory to have disclosure of those three items, irrespective of the size of the company. It's at member state level. Now, that's not particularly good for harmonization. How do you know if there's if you've got a company in Spain where you may have one set of rules, you've got a company in the UK with a different set of rules, and a company in Poland with a different set of rules with regard to fundamental disclosures. So this is where, at least in the US, you don't have member state problems as we do. Again, on this slide, there are certain things that they are looking to deal with. A lot of it circulates around the requirement for audit, which I know is different than it is in here, but some countries see it as quite fundamental in the workings of their economy. In Cyprus, for example, they have the thresholds, and you don't have to file. You don't have to have an audit below a certain size of company. But the tax authorities say that you can't file a tax return without an audited set of accounts. And so they get round it. So two parts of the same government aren't in unison, and then you wonder why we have some problems in Europe. As far as our fee positions are concerned, the disclosures really we must have. It must be better, but there is the subsidiarity principle within Europe that causes problems. We do believe that member states should have the authority to have small companies included in the audit regime if they wish, and also to use IFRS for SMEs if they wish to do so. Timescales on this: the next meeting is in December of the Council, European Parliament plenary vote in January. It's likely to change because of all this discussion. It is work in progress. There's not a lot of optimism that this is going to get settled in the space of a first reading. And so I think on that, watch this space. But with regard to what's happening around the world and the interest that's being shown, it's more in the audit policy that we have. And let's just think about what started this. And it was touched on in the last presentation. So what started as a liquidity crisis turned into a financial crisis, and then we got the sovereign debt crisis. And that sovereign debt crisis has resulted in major austerity programs in many countries across Europe, and you can see riots in the streets in Greece and major strikes in some of the other countries. And we're seeing the impact of this across everything that is happening in Europe, because it's impacting on the people in the street. And the people in the street are voters. And that is one of the major issues. So this is now political. And politicians see the auditing profession as actually quite low-lying fruit, low-hanging fruit. They can pick it, and they can change it, and they can use things. And yes, there were things, and we heard the dog didn't bark. But if you actually analyze, first of all, what happened, and I'm on the board of a financial institution, it really started with the liquidity crisis, when the whole financial system stopped. Banks were not lending to banks. And so it's little wonder that you end up with a bailout, because they have positions that they have to move. And have to keep turning. And so there was no turning, and therefore the whole system. So the liquidity crisis was the first trigger, and it's not necessarily an audit issue. But the audit profession has to be part of the solution, and we can't have a situation that we had before. We have to say more. As Jim mentioned, reporting. As I said, I'm in my 50th year. Anton's Institute is 156 years old, and they're not. I remember when I started, it was 3 lines, not 3 paragraphs, and basically said it showed a true and fair view, and that's all the information that the stakeholders got, and now the stakeholders are not just the shareholders. They just don't own the stock in a joint stock company. It is much, much wider than that. And therefore, we as a profession have to understand that, react to it, and make sure that we provide what other people want going forward. So that is, I think, particularly important. So in Europe, at the same time that all this was happening, there was a change in the European Commission. The commissioners rotate every 5 years. And so everything that was done on audit policy and accounting really stopped as they changed the commission, and new people came in. And so that 5-year rotation caused an issue. But not only was the new commissioner, did we get a new commissioner, we actually got a professional politician from France. And so take the two things together, of a professional politician in this environment, and bang, you get a real bullseye. That there he is in a position, and that he can influence what's going on. And therefore, we've got a politician involved in a political situation. And so here is our commissioner, Commissioner Barnier. And as he's often said, he's talked about status quo, but he says business as usual, as far as he's concerned, is not an option. And so what did he do? He said that no subject was going to be taboo when he started. We had the Green Paper in October 2010, and it covered lots of good things. Lots of good things, but also there were some very poor things in there. So, you know, the good things were questioning the role of the auditor, talking about communication by auditors to stakeholders. He said that international standards on auditing should be adopted in member states, and you saw that currently 20 of the member states have ISAs, but the larger ones, they've moved their own standards closer and closer to ISAs, but France and Germany and Spain are not there, and so it is important that we do that. He wanted to look at the governance and independence of audit firms, supervision, the oversight bodies, looked at market structure and concentration. We've heard about that I'm sure you've heard about it over the last few days, but certainly heard about it today. We at Fee don't get involved in market structure and concentration issues because we represent the whole profession. We represent small practitioners, we represent the big four, we represent our member bodies. And so it's very difficult to get into a debate about market structure because there's always winners and there's always going to be losers. So that's important as far as we're concerned. We have things to say, but we have to be relatively neutral in that. They wanted to talk about a creation of a European internal market, transfer between member states, people being able to practice in other member states. They want a simplification for SMEs and SMPs. This releasing the burden, I talked about that with regard to the accounting directives. And eliminating the requirement to disclose certain things. And they want simplification for SMEs and SMPs. And absolutely fundamental, and fundamental as far as the US is concerned, he took it on himself to make sure that there was going to be international cooperation. This was not going to be at the boundaries of the European Union. This was a global issue as far as he saw it, and he was going to influence that debate. He went out to consultation. They got lots and lots and lots of input from all the stakeholders. They had amendments that came from the European Parliament. On the day that the European Parliament presented their amendments, Commissioner Barnier actually issued the proposals. He didn't listen to Parliament, and he didn't listen to all the stakeholders. He drove his own truck and said this is what is important as far as he was concerned. And so now we've got the proposals, and they're split into two sections. One is the directive, and one is a regulation for public interest entities. Now this is a problem because what you're actually doing now, you're stratifying the population. And you're saying this is for public interest entities only. But at the same time, you're saying you want to move away from market concentration and choice. So actually, if you're having different standards for non-public interest entities, along with public interest entities, then clearly you've got a two-tier type of thing. And what we're talking about in Europe, because of the structure of the market in Europe, that this is quite an issue. And member states in particular don't like having regulation. You can understand that because they don't have any flexibility. But the European Commission want regulation, they don't want directive. So there's tensions between the instrument that is going to be used for this, this legislation. The proposals, no doubt you've seen all these, qualification, mutual recognition of professional bodies, etc. Looking at, I've talked about auditing standards. Supervision, they want more supervision, more European supervision. They want individual audit firm inspection reports. I know that PCAOB do issue their inspection reports. But in many countries, that isn't the case. And a lot of companies, or a lot of firms, are caught into the net where the oversight board will be issuing individual audit firm reports. So audit supervision, no practitioners in the governance of public oversight system, which is an inevitability. You know, you can't have self-regulation. You know, the phrase was, it doesn't stand the, that was mentioned earlier, doesn't stand the smell test. And it does, you know, it's much better to be clean, but you still have to have some input. The role of professional bodies is particularly important because basically the European Commission's proposals limit them to the delegation. Only thing to delegate to the professional bodies is the registration and approval of auditors. It's like licensing your car. That's all they're expected to do. And what we are saying, and a lot of others are saying, what about ethics? What about what Anton was talking about? The professional body causing behavioral change to make sure that people want to work within a professional environment, not just have a licensing authority to do this. Not involved in qualification, not involved in all aspects that you expect a professional body to be involved in. So it's really cutting across what they do. But fortunately, as you will see, the Parliament and the Council of Ministers don't agree with it. And they do want to extend the definition of public interest entities. They've got this audit, the auditor's report. The one that you see in the proposals, it is very prescriptive, it's very detailed. It even tells you how many characters, maximum characters you can use in your audit report. And it cannot be more than 4 pages. Ludicrous, and a lot of people have seen that. Firm rotation, you've had lots about firm rotation, but 6 years is the proposal with a cooling off period of 4. Audit-only firms was touched on. This is really a proposal to break up the dominance of the big 4. And it means that now this is one where the market has reacted very, very strongly against, because they see that a lot is provided by having the expertise to do complex audits within a large accounting firm. And you also want the mid-tier to develop, if they're going to be involved in this market with regard to market concentration, you also want them to be involved in being able to gather that expertise. Non-audit services is a big agenda item. And so the key battlegrounds are going to be mandatory audit firm rotation. We believe that there is a political dimension to having joint audit. This is not the joint audit that's currently in France. This is the joint audit where you have a large firm and a small firm in order to develop expertise. A lot of people, well, most people are against it. But it's been dropped by the European Commission. But some politicians see this as one of the solutions. And some of them see the mandatory audit firm rotation linked with joint audit as being a possible solution. I don't think it is, and most people don't think it is. But it's, as I said, we're in the political space. Non-audit services and this legal instrument, whether it's a regulation or a directive, is particularly important. So, what's Parliament saying? The Legal Affairs Committee, which is the main committee, has reported. their initial findings. They're now out again, where more amendments come in, and this is where I was saying that a minority party has to get the majority on side. But they don't want to regulate the market into such an extent that it freezes the market. This committee does support audit firm rotation, but at the end of 25 years, as a backstop position. They want the market to deal with it during any intervening period, but 25 years is the backstop. They do want ISA adoption. They want the IASBA code under IFAC to be where it is determined which services you can and can't provide to your audit clients. They are looking for strengthening of audit committees. They want the alignment of auditor reporting, not the model that the European Commission is doing. So you're going to have a European audit report, but the IAASB project. And they want a more limited role for the European Union oversight body, which is ESMA, which is the European Securities and Markets Authority, where they want to put most of the oversight. They don't support the limitation of delegation of professional bodies. They don't support audit-only firms, and they most certainly don't support joint audit. Econ, which is the Economic and Monetary Affairs Committee, so they're all having their say. The ones in the light blue are the ones where they agree with what's happening in the other committee with the proposals, but the dark blue ones are where they're different. So this committee is saying there should be a limitation on the delegation to professional bodies, whereas the other one's saying there shouldn't be. They think there should be a tendering process for non-audit services. Don't know how that's going to work when companies want, how is that every service, etc., etc. But they also want mandatory tendering for audit every 7 years, but not, and that's linked with the situation where this group don't want mandatory audit firm rotation, whereas the other committee do. So as you can see, even within two committees within Parliament, they're talking different things. And then you've got the Council of Ministers who've got different views being expressed. They do want the audit report. They think we should wait for IAASB. They do want a clear list of prohibited services for non-audit services, but safeguards for others. And they certainly have concerns about the pure audit firm. So there is this compromise trying to be worked out by the Cypriots. Where are we? Where's the profession? Obviously, professional bodies should be involved. We think that the PIE definition is too wide. It's now getting cumbersome, and the oversight bodies won't be able to deal with the volume of firms that they have to deal with. And you can see the other points that are on that slide where we sit. The timeline, which was a question earlier. Well, the committee votes, they're talking about early 13. I've had meetings at the European Parliament and with the European Commission. They want it to be as quick as possible. But I think that this is probably optimistic. They want a plenary vote by 2013 and a council vote under the Irish presidency, and that's up to June, the end of June 2013. If it goes past June 2013, Lithuania will not be able to deal with it, as I said, and Greece certainly won't have it on their agenda. And so it is quite a problem. There will be transitional proposals, so it won't all come in all at once, and that's why 2015 was talked about. But this legislative process, there's a lot. It's got a long way to go. It is work in progress, and it is likely to change. And again, it comes back now to the horse trading that is going to take place. I just hope that we don't get into the ludicrous situation where people start horse trading matters with regard to our audit profession, with regard to fish quotas and other farming regulation, because that's what can happen in the European Parliament, because they're out to get what they want as politicians. And if you have there was Kate Swinburne, who I was talking about before. She had 27 pieces of legislation sitting on her desk at one time that was imminent, that she was dealing with personally, that was imminent. Now, if she's dealing with that and she wants to get stuff off the table, then clearly we're in a position where anything can happen. And that's why we're working so hard to try and make things different. And one of the things that we are doing is that we are continuing the dialogue with the stakeholders. We're heavily involved with the rapporteurs and their officers. We've tried to help them to draft certain amendments because we understand, they don't understand the market. You know, they're politicians. They don't understand the audit market. They don't understand a lot of the things that they're asking to be done. We have strong engagement as a regional organization of IFAC with IAASB, and we engage with the PCOB. We've done a piece of work, surveys, roundtables on the role of audit committees. We've published 4 briefing papers, primarily to try and educate the parliamentarians on improving auditor reporting, provision of non-audit services, ISAs, and public oversight. It's an education process, and we are in close contact with our fee member bodies, because a lot of work is being done locally with their elected members of parliament. And we're currently working on a paper relating to the future of audit, because I think it's important that we as the profession actually look to the future, not worry about what's happening today, what we've done in the past. We should be driving what our profession should be doing going forward. And it will be, as was mentioned today, it will be different in 10 years' time. Therefore, let us be sat behind the steering wheel rather than just a passenger at the back. So there is a lot that is being done. There's a lot to do. There is a time scale. And as I said earlier, the problem is that we've got the situation where more and more jurisdictions are seeing what's happening in Europe and saying, perhaps I might like a piece of that. Thank you.
Of course. Philip,
Tell you're a president.
it might be helpful. It was to me when I learned about the difference between a directive and a regulation. I'm not sure that a lot of our folks here are particularly attuned to what that differential is. If you could share that with us, and then I have one follow-up question for you.
Yeah, obviously there are different instruments, and a regulation is important to the European Commission because it impacts immediately in its entirety once it's passed by the European Parliament and the Council of Ministers. So when they got this co-decision and it's agreed, then it's imposed.
And it's on all the states, right?
All 27 member states have to take it as is.
As is.
You can't touch it, and it's there. And so it really is a blunt instrument as far as the member states are concerned. Whereas a directive is more, it is a legal instrument, but each member state has to transpose that into their local legislation. And so they have to enact it within their own jurisdiction. And we all know that when things are transposed, that there is always a possibility that some nuance, particularly when you've got all the 21 languages of the European Union, that there might be some differences in interpretation of what the language means that the directive's in. And so there is more flexibility. And also, it doesn't come into operation immediately. And so you've got the situation where when the 8th directive, the Statutory Audit Directive came in, it should have been completed by 2008. But in 2010, it was just finally getting traction in some, being polite, traction in some of the member states. And this is one of the other problems, of course. The Statutory Audit Directive has lots and lots in it with regard to Audit Committee. And the one thing that was the last thing to be implemented in a lot of the member states was the Audit Committee and what Audit Committees had to do. And you heard before that it's not like the US and Canada and the UK where audit committees have been, they've got authority, they've got power, they can do things. In a lot of member states, they're not 2 years old yet, and they're still trying to work out how they're going to deal with it. And so, you know, the corporate governance structure is quite difficult. And that's why the European Commission want the regulation, because they can impose it. Whereas if it goes to the member states, there's a time lag, and it's not quite exact. You know, it's not quite the same in every country. And so those are the main differences between the two. And they're using the regulation only for public interest entities. And so for all the other companies that are audited in Europe, they're in a different regime. And again, we don't believe that you should have two separate rules with regard to the same principle. Yes, the scale is different. Yes, you have to do more things. You know, if you have to do a group audit if you've got a group, but and not if you've only got a small company. So the principles have to be the same, and that's one of the major issues that we have. And that's why there is this big debate about what instrument is going to be used. And the Commission really don't want to move away from a regulation, but the Council of Ministers want more there will be a regulation and there will be a directive, but it won't be in the same balance as it is now. Some things will move from the regulation into the directive.
Thank you, Philip. That's very, very helpful, I think. The other thing that I wanted to follow up with was the IAASB's invitation to comment on the audit report. There's been a lot of discussion here in the U.S. about the Audit Commentary. Could you maybe share with us the FEE's view on that?
I actually was in the round table that took place in New York, and obviously we attended. I didn't personally attend, but we attended the round table that was in Brussels. And we found that it was quite, the dynamics were a bit, and Jim obviously was there, the focus was a little bit different. I got the sense from the report back in Europe that it wasn't as much against the commentary. What we're in Europe is perhaps here, and I think litigation does have an issue here. We have said that from the fee perspective that the outcome of an audit basically is the best kept secret that there is. That, you know, we work for X thousand man hours, we do all these procedures, and then we tell you nothing at the end, that you've either passed or you've failed. And in the files, there's all these gems. But the question that was raised earlier about what should be said and what is the role of the auditor, we're absolutely firm on the fact that anything that relates to that is the company has to be reported by the company. You can't have the auditor giving information about the company, about its business model, etc., etc., etc. But what you can do is deliver what you're delivering to an audit committee to a certain extent. You can actually say that these are the key audit risks for example. And you can talk about those so that the reader of the accounts, of the financial statements, can get a feel for what the real priorities are. Because it's not just the financial statements that the stockholders get their information from. Of course, all the analyst briefings, there's no assurance on analyst briefings, but that's where share prices move on announcements. They don't move when the 400-page financial statements drop on through somebody's letterbox. And so it's just part of the whole process. So it does help stakeholders understand the business and what the risks are within the business. Now, one of the criticisms of what is being proposed is that it takes you down a journey as to what are the important things. Now, what's important to you may not be important to me. And if you're an employee, you may have different things that are different importance than you are for a regulator, or you're a supervisor, or you're a stockholder. So I think you could end up trying to cover everything off in the audit commentary. And I just think that you're much better sticking to what the key issues are, how you've dealt with them, if you have that. But that's a personal view. Obviously, others have different views.
I'm sorry, I usually stand with my back to the wall when I ask a question.
That's only so you can get on the camera.
No, the bullseye on my back is for... the subject is the device of the audit as public information or as information for stakeholders versus the company and/or its board of directors or board of governors. Has there been any discussion or dialogue or strategic thinking of where this dynamic that we're dealing with today in the U.S. as well as in Europe evolves over time when those of us who wear earbuds all day long and don't deal with this become more involved and responsible? Is there a website function for a company to post critical disclosing information, as well as maybe a daily, weekly, or monthly, or some periodic a semblance of risks, company risks, business risks, industry risks, that are identified for the stakeholders by the company, as opposed to the audit becoming the device from which public policy is achieved? Is that a fair question?
It is a fair question, and it's a major problem because the way things seem to be developing is that the auditors are being asked to provide information that the company isn't providing. And you just have to go to stakeholder meetings and all the people who say, well, we want this information. You must have all this information, share it with us. But really, it should be the company that's sharing that. But how do you make the company to do that? You've got to change the financial reporting framework. You've got to change the corporate governance code. You've got to do things to make the company. Take going concern, for example. In the European Union, and I know it's the same for IWSP, but in the European Union, they're saying, if we can get the going concern problem solved, we're 70% of the way there. But what they started was, they wanted a health check on the company. Well, you can't give, as was mentioned earlier today, you can't give a health check on a company. Lots of things can happen to a company. And so we're in a position where now the auditor is going to have to, likely in the very near future, is going to have to disclose more about going concern and what the auditor has done, et cetera, et cetera. But at this point in time, that same imposition is not being, or same requirement is not being put on the company. and the board of directors. So we have to have frameworks. You know, we work on frameworks. We were talking earlier about sustainability and integrated reporting. Yeah, for an auditor to work, there has to be a framework on which they, well, you know, you've got the financial reporting framework that you do, whether it's FASB or whether it's IFRS, whatever it may be. You've got to have a framework on which to report. And so the company has to give the information about going concern and what its critical risks are for the auditor to be able to comment publicly. So the onus shouldn't be being continually put on the auditor to do things. The other areas of financial reporting and corporate governance has to move in step. And this debate is one I've had at the European Commission. And I'm saying you can't have the auditor dealing with all this. They've recognized that now. And they're saying, well, we might use the 4th and 7th Directive, for example, to cover things like the requirement for more disclosure on going concern. We might, you know, we're going to link the debate on corporate governance and bring more in there with regard to audit committees. So at least we're now starting to talk about having some joined up writing between financial reporting, corporate governance and audit. And once you get that triangle working properly, then the stakeholders will get the information. It'll be provided by the company in a governance regime that is strong, with the auditor giving assurance on that information. And again, what was talked about today about sustainability, it's, if nobody looks at it, the biggest strength of an audit is the fact that it takes place, because it helps. It starts with the company having propriety in its financial statements. You know, most audits, you don't need adjustments, material adjustments, because the company makes sure they get it right first time. That's the real advantage of audit in its raw sense. And that's what you need to make sure that all these mechanisms work together. And yes, the use of technology, where will we be in, you know, we've got XBRL, more and more information. And we were talking earlier about cutting and dicing, analysts cutting and dicing financial information. That's the future. You know, Anton was talking about his smiley or his sad face, but it is all about communication. And the FRC, with their audit report, all this liability stuff that is built into an audit opinion, they're saying, just refer to a website. If they want to go and look at it, go and look at it in the audit opinion. Let's just see what the real facts are, what the real message is, and not have all these other words that are always in every single audit report. You can have them on a website and go and the companies could do that. They can give more information, and they can bring it all together as well. The big issue with Northern Rock, which was the first financial institution in the UK that collapsed at the financial crisis, all the information about their business model was within the financial statements. Every piece of information, everybody criticized the business model. It wasn't sustainable. They had 76% in the wholesale market. Once the wholesale market stopped, bang, they couldn't work. It was all in the financial statements, but it was like confetti. It wasn't all brought together. It wasn't brought together as the major business risk. And that's what we're saying, is that if you bring all the business risks together, the company reports its business risk. If the auditor looks at the audit risk, because they're not necessarily the same, because you're talking about a period of time, short period of time, 1 year, with your financial statements, whereas your business model can be a 10-year process. So they might be different, but if you give the information, people can make judgments then, and I think that's where we'll end up. And technology, yes, because in the UK, the post office, they stopped delivering HSBC's financial statements because it was a health and safety risk to the postman. Have I exhausted the questions or exhausted the time or both? Can I thank you for the invitation to speak, and I hope that at least you understand the complexities of your work.
Thank you, Philip. We have 11 countries represented here today. We've heard from the U.S. and Canada. Are there any other representatives here that would like to share their comments on what they've heard today or what's going on in their countries?
Hi everyone. I'm Riyad Al-Mubarak from Abu Dhabi, from the United Arab Emirates. I've been listening, I think, for the past 3 days to this wonderful presentation. But I thought to share with you also my own view on what I have heard. I think what we're missing in this profession is innovation. Because what I hear when I hear these regulations, speaking of most of the regulation, you see them really not very auditor sort of regulation that they're looking for. What I mean by this, for example, a lot of talk about auditor and CPAs. Just for example, the CPA or the auditor spend only 5%, and I think this is in most audit, 5% of the charge hours or hours spent by auditor is by the partner who signed the audit, where we leave the 95% of the time spent is by the audit team. We hear very little about the audit team and their qualification, for example. So this has always been a discussion that we have back home, and we never hear it in this regulation. Why don't you regulate this, the team members as well, not only the auditor? Because the audit team's member spend, as I mentioned before, 95% of their time in that one. Another thing we're discussing, obviously, the rotation as well, the mandatory rotation and tendering. For us, I think back in the UAE, we've made a decision 5 years ago for mandatory tendering and the public listed company, at least most of them, especially the one that partially owned by government. And with this also we bring other rules as well, not only rotation, we also bring sort of what is the technical evaluation requirement, because tendering, mandatory tendering by itself will not guarantee a rotation. So I think that's what I mean when I talk about innovation on these regulation, because sometimes we hear just a high level of regulation, but it's really what it matters in the end of the day is the details. So if you take mandatory tendering, for example, in its face, it's not going to help a lot. But if you think you know, just a little bit further of how, for example, how do you really tender and how do you evaluate tendering, then you will get the objective, I think right. Another thing we hear about, and I really feel for the auditor when I hear their auditor report doesn't mean much when it's only pass or fail. I don't think this is fair comment, because at the end of the day, this is what auditors do. They come as independent individual to tell you the numbers are right. This is not about pass or fail in my view. It's someone independent telling you all the numbers that you see, they are right or wrong. So disclosing, for example, materiality in the auditor report, that the things I think that we are discussing again back home, and we are thinking that will make a difference. If everyone knows materiality, I think that will help also the investors. And I can go on, but I thought just to share with you some of the things that we've been sort of debating back home, and they are obviously similar in what you hear, but some of the experience or the regulation we have already passed, and luckily we don't have the same legislation issue. Sometimes it helps. I see the process that you just demonstrated. I can imagine how long it it takes to pass. But I think I see we're fortunate sometimes to pass this legislation and faster than other countries as well. And just thank you for the opportunity as well to speak with you today. Thank you.
Thank you for your comments.